This week we dig into a silver and or gold bullion buying discussion. Which one or mix of these two precious monetary metals might be best for you and why? But first, a bit of some ultra-violence from the Middle East. This past week, the world witnessed the Islamic Republic of Iran's armed forces shoot some 22 long-range surface-to-surface missiles at Iraq's Al-Assad air base housing U.S. troops, none of which were reportedly killed. But in the fog of violence between two long-standing enemies, the truth is going to be the first casualty virtually always. And while early reports said otherwise, facts from the sky and elsewhere show that 17 missiles indeed struck targets within the U.S. and Iraqi military bases. In other violent Middle Eastern news this week, an international passenger plane bound from Iran to Ukraine was allegedly rocketed out of the sky. All 176 lives aboard were lost, God rest their souls, and 63 of the tragically killed plane passengers were Canadian citizens. All were victims of perhaps an overly aggressive missile launch trigger finger of the Iranian side. Certainly more facts will come with future investigations. And certainly this Iran and U.S. near 7-decade-long historic coup, hostage-taking, terror plot, and violent skirmishes, they all remain far from over. All this violence and ratcheting up of aggression in the Middle East caused the gold spot price to shoot past 1,600 fiat Federal Reserve notes overnight, this past Wednesday, January 8th into January 9th, Thursday. The global fiat currency debasement trend ongoing. It has been sown for decades, and there is no undoing the energy that is about to be released. All four major precious metal price trajectories appear ready to begin climbing higher. Most obvious is palladium ongoing, but also look at gold and even silver and platinum, if you look technically at the shapes of these long-term charts. Consider not just the short nor even the medium, but mostly the long-term trajectory for major precious metals in the 2020s and beyond. Given that many new bullion buyers are coming to buy for the first time, this week we're going to focus in on one of the most basic questions a beginning bullion buyer typically asks themselves. Should I buy silver and or gold bullion? Which and perhaps what mix of these two most historic monetary precious metals might be best for bullion buyers and why? To start, how about a realistic thought experiment? What if we had the opportunity to buy gold bullion today at around 800 fiat Federal Reserve notes per troy ounce, with the lone caveat being that we could not cash in nor lay our greasy hands on that gold bullion for about a decade of time from now? Who among us would be willing to lock in such a future savings on gold bullion today, knowing the patience and time required in awaiting for the eventual payoff? Of course, in life, not one of us is guaranteed tomorrow. While we should try and enjoy each and every day, we must operate under the assumption that we will indeed live long lives, and thus we should save accordingly for that long haul. The proposition here is not whether we save, but more so in what specific monetary units might we do so. No sane person looks out at their future without referring to some portion of their individual past. By doing so, we human beings at the very least have a potential range of outcomes to consider. This week's subject matter, it's no different. We'll do something similar as we ask ourselves the often bullion buying 101 question, should we be acquiring gold and or silver bullion? We're going to examine the typical underlying motives for acquiring either silver and or gold, and two, we'll drill down into my suggestion about affording 2 times the gold bullion probably within this decade or possibly even the one to come. How might we do that? After this week's 4 major precious metal fiat Federal Reserve note valuation update and market insights, we'll go into answering that question along with a few other market updates. Hello out there, I'm James Anderson of SD Bullion, with more than a dozen years working and investing in the physical, high-volume bullion industry. This week, the precious metals again showed strength in the face of rising Middle East tensions and violence. Gold, as mentioned briefly, passed 1610 per troy ounce interweek, and appears the gold spot price will be finishing this week above 1,560 per troy ounce. The spot silver price is closing the week around 1815 per troy ounce, denominated in fiat Fed notes. The platinum spot price stayed relatively flat at around $9.84 per troy ounce. The spot palladium price went aggressively upwards to another new all-time nominal Fiat Federal Reserve note high. It now takes over 2,100 fiat US dollars to acquire a physical ounce of short in supply palladium bullion. Finally, the gold-silver ratio stayed relatively flat this week, still requiring about 86 ounces of silver bullion to get 1 troy ounce of gold bullion. There'll be more discussion about this ratio to come in our updates topic this week. But first, a few important market updates for viewers. Margin requirement hikes. The CME Group hiked margin requirements this week for silver futures contracts by 6% and gold futures contracts by 11%. Margin requirements matter for a few big reasons. First and foremost, the spot prices for silver, gold, platinum, and palladium are mostly driven, at least for now, by futures contracts trading on the CME Group's COMEX and NYMEX commodity exchanges. Many futures traders betting long for major precious metals to rise are typically betting against commercial banks who have larger capital pools, and thus when margin requirements get heightened to levels we saw in, for instance, 2011, well, many of the weakest hand long bettors, they disappear and or get flushed out to the downside eventually. For instance, in 2011, it cost around 25,000 fiat Fed notes in margin parked with the CME clearing subsidiary just to trade one silver futures contract, which represents 5,000 leverage fractionally reserved silver ounces on that exchange. Today, that margin requirement is just over 5,000 per silver futures contract. Commodity market manipulation continuation news. We have a letter from CME Group to CFTC regarding their central bank incentive program. It's January 2020, and it's again that time of year when the CME Group extends its foreign central bank incentive program. The CBIP essentially invites approved foreign central banks or those financial intermediaries trading on behalf of those foreign central banks to come into our nation's financial and commodity price discovery markets and trade in high volumes at a discount. This has been going on since late 2013, where foreign central banks have used the CME Group's central bank incentive program to likely move prices according to whatever their agenda may have or continue to be. With the ability to create virtually infinite fiat currency out of thin air, approved foreign central banks can trade foreign exchange, interest rates, or commodity price discovery contracts including gold, silver, platinum, and palladium. The sarcastic news of this ongoing market rigging scandal is that the chief lawyer for the CME Group told the secretary of the CFTC, the Commodity Futures Trade Commission, the one who's supposed to regulate the CME Group, late in last year, 2019, that there will be unnamed CME Group, COMEX, NYMEX, and CBOT staffs who will monitor trading in the central bank incentive program's products so as to prevent manipulative trading and market abuse. In other words, you can expect the exact opposite. The bright spot in all of this is to know even recent history shows that overt fiat financial market manipulations, such as these, they may prolong what's going on, but these manipulations cannot endure forever because of physical reality. See the NYMEX palladium drain from 2014 onwards. A similar drain has happened to palladium ETF bullion holdings worldwide. The fiat price for short and supply palladium bullion is now over twice what it was back then in 2014, and it's threatening to climb exponentially higher without platinum thrifting to come. We suggest again that given all the fiat currency debasement, which has been underreported and built into the global financial system already, similar bullion drainage scenarios are likely for the other three major precious metals to come. Onwards to our topic of the week. Gold versus silver, which to buy and why. Here we're going to dig into why investors might choose gold and or silver. If you're buying bullion, you should consider each of these two classic precious metals in varying proportions depending on a multitude of factors we're going to cover here. Typically, in my more than dozen years working and investing in the high-volume bullion precious metals industry, most investors, once informed, will choose to allocate a portion of funds to both the historic yellow and white precious monetary metal. The question of what amount in either precious metal is what we will dig into detail here. If you're sitting on some potential nominal stock market gains, especially from the second half of the 2010 decade, well, now's a good time to lock in and crystallize some of those profits by acquiring a prudent physical precious metals bullion position. We now have nearly 50 years of simple math and arithmetic data which prove that while living under a full fiat currency monetary regime, it makes common absolute sense to hedge stock and bonds with a prudent position in bullion. Given historic precedents in most readers' lifetimes, even a 10% bullion allocation is likely not enough. The best risk-to-reward ratio for prudent bullion allocations over a 50-year time span, roughly, has surprisingly been about 2.5 times that amount, looking backwards and judging it S&P 500 versus U.S. debt versus bullion. Moving forward, I'm going to assume you understand why, to begin the 2020s, allocating a portion of one's wealth into bullion makes long-term value sense. The list of whys is exhaustive, and the numbers are into trillions of yet to be accounted for reasons. In the next commodity boom to come, the mania for these two precious metals should reach historic levels, outperforming any bullion bull market past and probably to come in any of our lifetimes. Remember, too, that physical silver and gold bullion are some of the lone remaining assets you can own outright, very privately, with no risk of a complete loss other than outright theft. Physical precious metals, like silver and gold, will always retain value among human beings. So how should one place their bullion bets with gold or silver? Or a mix of both silver and gold, perhaps? Over the years, I've had the privilege of speaking with over 10,000 investors who have actively considered, at the time, which mix of the two precious metals made best sense for their objectives. My suggestion then, and it still remains, the following. Write to yourself a 500 to 1,000 word letter and write to yourself why you are interested in getting a prudent physical precious metals position. Literally write down the motives and the reasonings for your wanting to do so. Then read it back to yourself. Ask yourself the following regarding what you wrote down. What percentage of the underlying motives are to keep the purchasing power of what you've attained? What percentage of the underlying motives are to enhance the purchasing power of what you've attained? If over the long term you want to keep the value of what you've saved with less volatility in a literal pack of government-partnered central banks creating currency out of thin air who are buying gold right along you, then buying gold bullion, that's something you should consider doing. If over the long haul you want to increase the value of what you saved and you can stomach price volatility and the madness of crowds while also having a long-term patience, then buying silver bullion is certainly something you should consider doing too. Consider the performance of these two precious metals throughout this full fiat Federal Reserve note era. We're talking about post-1971 Nixon's full fiat US dollar regime that's currently still in play. Look at the increases from 1970 to 1980 for silver versus gold. Obviously, silver in the overall spectrum outperformed gold. That's if you traded it perfectly. Kind of hard to do, and the timing was late rushed. Silver really did its work from about 78, 79 to 1980. The fall from that precipice was very dramatic for silver and went down almost 90% from its peak in January 1980. Gold, pretty similar, but not as bad. It went down roughly 66% from its 850 fiat Fed note ounce perch in January of 1980. The increases in 2008 to 2011, after the global financial crisis when QE1 and QE2 were getting underway, currently not QE4 has yet to really ignite the PMs, but that's likely coming. For 2008 to 2011, you saw silver run up over 400%, gold ran up over 150%, and the falls, the price drops from those highs in 2011 have been pretty dramatic. Silver has dropped 70% top to bottom. Gold fell over 40% top to bottom. Obviously, things are looking up for the two major precious metals, but these are the data and these are the facts you should consider when you look out into the 2020s and even into the 2030s for which precious metal you may choose or what combination of the two. Other questions you need to consider. How old are you? In what time frame might you need this capital converted back into fiat currency again? Buying bullion is not a short-term trade. If you want to do short-term trading, go play in derivatives. If you want something for the long term or even the medium term, bullion is something to consider. Typically, older investors buy majority gold bullion as they understand the majority central bank gold buying is likely here to stay for decades to come. The financial world is underpinned by official gold reserves, and its role as de facto safe haven money is not going anywhere anytime soon. Generally, young investors, they'll buy majority silver bullion as they have decades to wait out what most bet is an inevitable revaluation higher for silver in the years to come. It's a common belief amongst many young people, myself included, that we'll again see silver bullion priced by more than 50 fiat Fed notes per troy ounce. It hasn't actually got there, but it eventually, I believe, will, and I think many others do. And more than likely, will threaten three-figure levels before this bull market mania reverts back to a historic valuation mean. In other words, you'll likely see three-figure silver. And that's just based on the amount of fiat currency debasement that's gone underreported in the last 2, 3, 4 decades. Historic precious metal bull markets tend to have gold lead and start the bull run, like currently it's doing. Then at some point, silver begins to play catch up as gold investors look to get more value for their precious metal bets. The chart below covers 1970 to 1980s Western nation-driven gold and silver bull manias. You can see how silver really only outperformed gold during the final year of the mania into early 1980. Remember, too, that this current bullion bull market of the 21st century is being driven by the East and the West simultaneously. This has never happened before. There's never been a global bullion bull market ever. And thus, this by virtually all measures, it's already been the largest on record from the year 2000 to now 2020. But this 21st century chart, I believe, reflects the fact that we've got more to come. And below you can see that silver outperformed gold from 2009 to 2011 briefly. And I myself expect to see something similar like that in the later 2020s and possibly stretching into the 2030s. Given that in 2015, silver bullion investors bought about 1/4 of the year's entire global silver supply, it wouldn't shock me one day to see that percentage double before this 21st century bullion bull market mania finally peaks. Remember, unlike physical gold, silver is a tiny market, currently worth only about $20 billion per year in supply. Now, that's a drop in the financial bucket because the financial world literally holds more than $300 trillion in liquid assets. And currently, we have a gold-silver ratio in the middle 80s. Most precious metal bull markets peak out with the GSR falls into relatively low points as it did in the year 2011 when it got near 33, and in the year 1980 when the gold-silver ratio dipped into the teens. What I'm basically stating is that the gold-silver ratio is likely to head back toward that low of 2011 and possibly beyond that. And so we have a gold-silver ratio right now in the mid-80s. If it goes back below 40, essentially, if you take taxes out of the equation, I mean, you basically doubled your silver gain versus gold if you go from mid-80s to below 40. It's quite possible, and in my opinion likely, that this 2020s and even 2030s version for the bullion bull market, we may see a gold-silver ratio back in the teens. There are many who are buying silver bullion right now with the intent to swap the silver bullion for gold bullion when the gold-silver ratio dips into lower historic ratio levels. By doing this arbitrage, investors could acquire more gold potentially than they may have if they otherwise simply bought gold today and no silver. Planning on this is difficult to do, obviously, and there's no guarantees, but this is a trade that a lot of people are betting upon, and they're considering to use some of their silver eventually to buy gold with, eventually when the gold-silver ratio gets lower. Other gold-silver factors to consider: the gold price and gold's value is just flat out more stable historically. Silver is nicknamed the devil's metal by short-term derivative traders for a real reason. It can shoot up like a rocket, and at times, its fiat price will also drop like a stone. Silver is more affordable than gold. You get way more silver troy ounces for your fiat currency, in other words. Thus, when the crowd comes buying bullion heavily, silver tends to outperform gold bullion in a short time frame historically. Gold bullion requires way less space for safekeeping and private storage. Silver has many more industrial applications and therefore real-world device and application demands than does gold. This factor sometimes produces silver spot price sell-offs, like in the fall of 2008, with the rationalization being there will be less silver demand due to shrinking industrial production levels upcoming. This factor also gives the potential of a silver industrial bullion buying spree and mania potential, as industrial manufacturing lines do not want to stop for a lack of fine silver bullion inputs on hand. Silver bullion held by investors across the globe in .999 form is slightly more than 1 million ounces or so than .999 fine gold bullion held across the globe. As the demand to buy bullion rises, the trend of average people choosing to buy less expensive silver bullion tends to make silver briefly outperform gold, as it did during the 2009 to 2011 run or its 1978 to 1980 mania phase. Much of the silver bullion that's currently held by investors is likely to get sold off in the coming decades to come and used in industrial applications. The internet literally runs on silver and gold-laced computer server underpinnings. And it too helps investors learn reasonings as to why silver is perhaps better value than even gold today. This was a major contributing factor in silver's January 2009 to late 2011 outperformance over gold. And we expect some repeat or rhyme of that scenario to come again, thanks to the speed of informational transfers these days online. The conclusion is this: that given current historical undervaluation of gold and silver bullion relative to stocks and bonds, or paper financial assets and real estate, now's a perfect time to be buying bullion as a long-term store of value and investment bedrock position. Both gold and silver should not only maintain their purchasing power near these current spot prices, but they should also enhance in value as this largest financial bubble bleeds away into real precious item valuation upsides to come. Considering all the factors we've discussed here when choosing between either silver and or gold, they're both excellent options. And that's why we offer them in high volume to investors around the world. That's it for this week.
Thank you for tuning in. And if you liked it, be sure to like the video. And if you haven't subscribed to our channel, do that. And also hit the alert button so you don't miss these market updates as they come along. Give me a comment below. Let us know what you think and what you'd like to see more of. Have a great weekend, everyone. Thanks for tuning in.